Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Crillo. Today we have Carl Suverkrop. Carl is a principal at Trident Multifamily and is a full-time real estate syndicator. Originally from South Africa, he immigrated to the U.S. in 2015 after a successful sale of his electronic security business. Carl has been investing in multifamily real estate since 2014, and with his partners at Trident Multifamily, sponsored the acquisition of 3 assets in 2019. So thanks so much for being on the show.
Great. Thanks, Charles. Glad to be here. And yeah.
So you're a real estate agent as well. So what was your professional background prior to starting with your partners, Trident Multifamily?
So yeah, let's say I've got my license. I've never practiced. It was kind of where I was heading in terms of the residential and acquiring assets, but I've never really practiced for anyone but myself. So that was not my profession prior to syndicating. I was still in security and doing security for apartment communities. So in Dallas-Fort Worth area, doing security evaluations, looking at all cameras, access control. It was really just a transfer of my knowledge from my business in South Africa to now the industry where I wanted to be, spending my time. So it was I guess a soft entry with the skills I already had into the industry I wanted to be in. So helped me get into some good connections and good networks here in the US.
Why did you choose multifamily as your investment vehicle when you started?
For a couple reasons. I love business. I love businesses, and I love real estate. And to me, commercial real estate and multifamily, it's a really simple business which you can understand and you can directly influence how it performs. So, I've dabbled in the stock market, trading out, doing all those types of things. And at the end of the day, there's the education and the time required to really understand, investing in Apple today. Man, I got no idea what's going on in Apple. I would have to be, looking up. It's very onerous, where real estate to me is a much more simple model where you can affect change and get an easier handle of what's going on and that type of thing. So
yeah, you definitely have much more control over it than investing in many other asset classes. Most of them are the ones that are kind of like pushed on us, I guess, especially if you have a job. You didn't have a job, so it's not really pushed on you with the 401k and stuff. But so what types of assets and markets does Trident focus on? Where are you guys looking?
So we are looking Texas, Arkansas, Missouri, Kansas, Oklahoma. So that's our sort of footprint. I'm in DFW. Mike Van, our partner, is in Springfield, Missouri, and Rodney Miller is in Oklahoma City. So with our geographical layout, we can kind of service all of those areas pretty well. And in terms of what we're looking for is cash flowing assets. That's really what we're looking for in properties in all of those markets, which make it a little tough in DFW at the moment. We're definitely playing in the C class assets. So, that is just super, super competitive. And to find anything that cash flows in year one, that's the part left out, needs to cash flow in year one, especially in DFW, is just extremely tough. But, across our footprint, we've managed to find quite a few markets where we can get really good cash flow from our assets.
So what is when you're evaluating a deal, what are the main factors? Obviously you said cash flow in the first year. What are the other factors that you have to check off before you guys actually bring a property to a letter of intent stage?
We have a lot. A lot is verifying how comfortable we are in terms of market comps. And for me is the just the income. Obviously at 90% of these properties we get a broker's offering memorandum, and they have a wonderful pro forma with the income growth just being astronomical. And it's like, yeah, this deal cash flows. You wanted a cash flow deal. Here you go. And for me, it's not realistic for a deal to increase income by 20% in what in the first year. Like it's just not going to happen.
Yeah.
So typically we want assets that will go into agency debt or at least qualify for agency debt. So our last deal we did, it could have qualified for agency debt. It had phenomenal cash flow.
Can you explain agency debt? Sorry.
Okay. So Fannie Mae, Freddie Mac typically want to see a trailing 3-month occupancy of more than 90%. And the property needs to be stabilized without too much deferred maintenance in terms of the mechanics, the roof. It needs to be a not distressed property,
right.
And that occupancy needs to be above the 90% mark. What we look for is a deal that is there, so operationally it's performing well, and then we can decide what we want to do. So our last deal, we could have gone the agency route, but we've decided to do a bigger rehab on the property, and we wanted to finance in a lot of that rehab. So we did go with a bridge loan on that deal. But the principle was that the asset was performing well. There's a couple times where people use different debt. Bridge debt, we've used it in this case because we wanted the CapEx dollars rather than we needed to use it because the property was distressed and at low occupancy and no one else would give us money. That's
usually the story with the bridge, though.
Correct. So we want to make sure that we've got well occupied properties in areas that have got great demand.
Right. And just so listeners, for the agency debt, so those Fannie and Freddie, they're government agencies, considered agency debt, and they're backed by the U.S. government, and they're very favorable interest rates. So it's kind of the gold standard for multifamily. Now they're into other classes, but for any type of commercial developer or rehab or syndicator, they want to secure that at some point. And when Carl's talking about doing bridge loan, when we're talking bridge debt, it's going to be a variable, and they can reset at different times. So it's a little riskier, but it allows you, as they were saying, they're going to do a much more value add. They're putting more money into it. They're making a more aggressive of a rehab on it, and that will greatly increase the property. And then, of course, you guys will then refinance out, I imagine, or sell it, and you'll go to an agency debt loan. Is that right?
Correct. Yes.
Okay. Awesome. So you guys are very conservative. I mean, I speak to syndicators all the time, and sometimes they're not anywhere near as conservative as you guys are when you're underwriting and when you're looking at deals. How does your company protect against a slowdown? So if there's a pullback in the economy, a pullback in the market of properties in?
So typically look for fixed rate financing. So I'll just stay with coming back to that bridge. What we did on that is we've purchased a cap, which is pretty much almost like an insurance. You pay up front and it caps what that variable interest rate would, the upper end of where it would go. So that was one thing we did there. The other thing, again, is finding great demand and cash flow. So that's why, again, thinking about a business, and I love business, is a business cannot operate without cash. Right. So a lot of people that I'm seeing are saying, don't worry about the cash flow. I just want appreciation. Just whatever's going to give me the biggest return in 3 years. If it's all on the back end, I'm okay with that. And to me, that's scary, because if it's not cash flowing, it means that, the during that 3-year window, the property doesn't have excess cash. So when things slow down, resets, whatever we want to call, if there's less income coming into the property, there's no buffer. So all of a sudden we've got less income. There's no cash flow. That's got to come from somewhere, right? The property's still got to operate. So for us, we make sure we've got properties that on year one, we are as close to a minimum of 10% cash on cash, and ideally higher than 10% in year one, so that and typically it should improve, as we progress. But we like to see a double-digit cash flow from year one, so that way at least if things calm down, or we've got that buffer that the business can still sustain itself, because no business can operate without cash flow. If you've got no cash in the bank, and these are living businesses, you've already taken a big line of credit in terms of the mortgage. You can't work a deal with a local bank and get more operational capital. It starts getting messy. So we like to make sure that our deals have got a good, strong cash flow base to them, and that way, as things need to be, things slow down, we've at least can take we've got some buffer on that cash flow.
Yeah. No, that's great. It's also great with having the cap on the bridge loan. That was something I should have mentioned as well. It's something you can purchase. So that's a way of really hedging risk over the next, I guess, 2 or 3 years, which is a normal rehab process period. So what is your role at Trident? Are you in acquisitions underwriting? Is that correct?
Yes. So acquisitions underwriting is pretty much what I do. I've got 3 screens set up here, and I just bunch of calculators that you're running the numbers. And then moving forward in terms of asset management, I handle most of the operations. Mike handles most of the CapEx. So, on this bigger project we're working right now, that part of the asset management kind of falls under Mike. But in terms of operations, I say I'm the one who's put the numbers together. I need to be accountable for the property's performance, and make sure my managers know that they're accountable to me to these numbers. And if we need to change something, we need to just constantly having a look at the effects of changing parameters in terms of the operations. So operations and asset management and the operations and the acquisition.
Yeah, because the asset management portion, that whole project management portion in the beginning when you're doing the CapEx is very time intensive, because obviously you're not, and a lot of times you might not be ending with the contractor that you thought when you started and stuff like that. And it's you're going to the site, you're making sure stuff's done, you're looking over the shoulder of the property manager, making sure that the rehab is going, you know what I mean? You're doing enough units, but not too many units. And it's a very kind of scientific process for keeping it money coming in, but also the units being turned over and re-rented. So
100%. It is and that's actually what we were sitting down yesterday is looking at the turn of all the units and coordinating, lease expirations with, offering a couple residents to stay month to month because we're not ready to rehab their unit yet, or the contractors are, not lined up. So it is a real, I want to say it's a logistical nightmare, coordinating move outs, move ins, So
and then trying to, as you're doing it now, it's smart, staggering the leases with the month to month. That gives people, so it's weird dates when they're moving out, different months than what they were before. So you don't have 10% of your people coming up on February 1st or March 1st, and then you have to do something now. But how did you find the rest of your current business partners?
So we joined a mentor program here in DFW. And luckily enough, we were in that program together. But it wasn't. It was through the program, but it was through a networking event, unaffiliated to the program. So we had kind of touched base, but we hadn't really dug into getting serious. And just a meetup where we learned more about each other. And I guess we'd been chatting for 4 or 5 hours, and all of a sudden we thought, we're all kind of looking for the same thing when we dug down, and we thought, you're in Springfield, I'm in DFW, you're in Oklahoma City. This is a pretty good ground that we're covering, because I see a lot of people partnering with people in their city, which is phenomenal and great, and it's good team, but sometimes it kind of limits your scope a bit in terms of, well, let's look at a new market. With these properties, you really can justify investing not where you live. And for us, when we put that piece together, I thought, man, Mike's got a really good handle on Arkansas and Kansas City. So, those are some great markets that we really have. It's a 2-hour drive for Mike. We really like Tulsa for a number of reasons. And okay, it's a longer drive for me, but that's about 2.5 from Mike and 1.5 from Rodney. Wichita, Kansas, we've been looking at a few assets up there, and really interested in Wichita. And that's about 1.5 hours. Rodney lives on the north side of Oklahoma City, so it's about 1.5 hours, 2-hour drive for him. So we're really able to cover a lot of ground, and that's where we thought, we're all looking for the same thing, and we just clicked well. But yeah, through networking and spending time with people, not expecting to find I don't think any one of us came into expecting to aggressively find a partnership. We were just, our agenda was to learn more about people before, who can I partner with? And we learn about each other. And it was thereafter that I thought, man, this would be a good group to partnership. So found a partnership by not looking for partners.
Yeah.
If that makes sense.
Yeah, no, for sure. Because we met at a networking event, and then we've seen each other at, obviously, we see each other 2 or 3 times a year at different networking events. Yeah. And when you're speaking to new investors, and they're probably where you were years back, how do you explain to them, what do you suggest them to do when they're looking for partners? What do you suggest them to do that maybe you guys did differently, or you would change if you went back?
Mm-hmm. Well, you've got to get out there. You've got to network, and you've got to tastefully be honest with your skill set. And you've got to be able to share what you're good at and what you can bring to the table in a realistic fashion, because ultimately it's all going to come out in the wash. But you just need to be, real honest with people. This is where I'm at. This is what I want to do. But let people know that. And the more people you know, or the more people you let know about that, the sooner or later, people, prior to Rodney and I and Mike connecting, I had a bunch of people saying, you know what, I know someone who you should connect with. And I'd had quite a few people that I met with and got connected with. So, the partners I ended up with were not, the first people that I connected with. I had connected with quite a few others, and it didn't, I'd kind of been through, dated a bit before I kind of figured out, this one feels right. Yeah. So, just tastefully share with everyone what you want to do, what your objective is, and what you can bring to the table. And, there's more people than will start coming out the woodwork.
Yeah, for sure. No, I definitely agree with that. Being upfront with what your skill set is and what you're lacking is probably another good part too, because some people are people and some people are numbers. And so it's, you got to kind of figure out the rest of your team. So what mistakes, because we were talking earlier about deals in DFW, which is Dallas, what mistakes do you see other syndicators or real estate investors right now making in our current market cycle? Other than picking up those deals that don't cash flow for a year?
So the part I haven't revealed yet is kind of my ace in the hole is my wife has been in the industry for 20 years. She's a regional property manager over 2,500 units for a big, one of the biggest management companies in the US. So operationally, I've got a lot of assistance and help into, how properties operate. She operated through 2008. She was actually in a lease up property in 2008. So she's been operationally through a storm. And the biggest thing that I see people, and just my opinion, I may be right or wrong or indifferent. The biggest thing which turns me off is when I see how much people or syndicators are projecting growth in income. I've seen quite a few deals lately where people are projecting a gross income growth of 15-20% in year one, and every property has a story, so it may or may not be possible, but I think people are being very aggressive with how much that they can increase just total income of the property, be it through rents or be it through other income. I feel that the projections of how much income or how much more income you can bring into the property, I think are very rosy. Given this time period we're in, we need to be, I think, pretty conservative with how much we think we can increase total income into a property.
Yeah. No, I see it as well in Florida as well, because we have like Tampa, for instance, 7-8% rent increases last year over the whole MSA. And we see documents going out and PPMs and stuff like this, and they're saying 15% in 1 year, just like you're saying. And so that's not only, you're telling, it's so aggressive where you're saying that you're going to be able that much value into a property where you're able to add 15%, and where so many Americans, almost 80% of Americans are paycheck to paycheck. That's someone that's going $1,000 now to almost $1,200, right? $1,150 and even higher in certain income in 12 months, which is just, you're going to have turnover of every tenant you have in that property. Even if you've renovated their units, they're not even going to stay. So you have to look for a whole new client base, whole new tenant base, and that's not that easy,
Yeah, and realistically, I'm yet to find anyone who's taken over a property in the first 3 months have gone like a dream, and the T3 collections from prior to buying it have just continued to escalate month over month in the first 90 days. The first 90 days are always a discovery period.
Oh, yeah.
Normally, if you've done the due diligence, it's pretty manageable. But needless to say, you cannot put your foot down. Most times, it's very difficult to put your foot down in the first 90 days and start running up those increases. So now we're looking at a 15% increase crammed into 9 months. Is realistically what the time frames start looking like, and it just, I don't think it's feasible. But again, every property has a story. So
yeah, for sure. And it's also that in that first 90 days, like you were saying, that's when you're finding out what the actual, because usually you get your leases created and stuff like this before you purchase a property. So the property manager is, for people who are listening, is giving you a grade just like you would in school of how good the tenant is. And that's great. You have an idea of what you're going into, but then it's also, it doesn't shake. You don't know until you buy it and you find out that this person's been paying late, later than they have. They haven't been paying a late fee. So you're like, well, now I have to add that to who's getting evicted. So you can't shake it too much because you can't have, you know what I mean? You
might say exodus, and the next minute you've dropped 20%. And
right. And right at that point, that first 90 days, you're just trying to keep everything manageable as you start systematically renovating units and doing work that has to most likely be done to the property that's been neglected, right? So, the main stuff that you're not getting rent increases on, roof, the parking lot, stuff like this, that you can't raise people's rent because their roof isn't leaking. So, stuff like this, but, well, it's very interesting. Well, thank you very much for being on. How can people learn more about you and your business?
Yeah. So, look me up on Facebook, LinkedIn, tridentmultifamily.com. My email is carl@tridentmultifamily.com. But yeah, connect with me on any social media, well, Facebook and LinkedIn. Or our website. We've got interested investors. Go there and we'll pick you up as that comes through.
Yeah, it's got all the, so if you go to the website, it also has their whole process of how they do it. So it's very interesting, which I don't see on too many websites. So I will put all those links, Carl's links, and also Trident Multifamily's links and emails in the bottom in the notes. And I'll look forward to, I'm going to see you next month at a
Yeah,
conference in Colorado. So I'll look forward to seeing you there. And thanks
that'll
again
be
for
good.
being on.
Thank you very much, Charles. Appreciate it.
Talk to you soon.
All right. Cheers.